Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Thank you for joining us on today's webinar, where we'll be discussing field services and understanding the difference between pre-sale and post-sale services. We're also going to be touching base on REO repair strategies. And if you have any questions for our panelists today, please type them into the question box, and we're going to save a few minutes at the end of our webinar to go through Q&A. I would like to introduce our moderator for today's presentation, Eric Miller, the Executive Director for the National Association of Mortgage Field Services. So Eric, I'm turning it over to you if you'll introduce our panelists.
Stephanie, thank you very much for the introduction. And we're really excited, NAFS is really excited to work with NADP on our initial webinar, joint webinar. And so as you indicated, we're going to be talking about field services, both pre and post sale, and some rehab strategies. We have a great panel, and I'm going to go ahead and let them introduce themselves and tell them a little bit about themselves. So let's go ahead and start with Glenn. Glenn?
Thank you, Eric. Good afternoon, everyone. Glenn Brooks with the Fay Group. I'm president of Property Services with the Fay Group, which includes our REO division, as well as our property management division, our construction division, and acquisition team. And I appreciate everyone's time today, and looking forward to answering any questions you may have at the end.
Brian?
Good afternoon, everybody. I'm Brian Lysakowski. I'm the co-founder and chief executive officer of ZVN Properties. We're a nationwide field services company offering a suite of services to both default and the SFR side. We've been around about 20 years, so we're excited to be here and be able to present to you all, kind of our take on the space. Thanks for having us.
Dina?
Great. Hi, I'm Dina Ray. Thank you for having me today. I'm looking forward to this session. I am Vice President for ZVN Properties for Property Preservation.
Thank you. Thanks, everybody. Again, appreciate your time and everyone who's on the call as we discuss, field services, pre-sale, post-sale. Obviously, as brokers, you're concerned about kind of volumes coming in, and what we felt was really important was to talk a little bit about what our side of the business, or the National Association of Mortgage Field Services, what we do as contractors, inspectors, as it relates to pre-sale properties, post-sale properties, and we'll talk a little bit about some of those strategies that are out there. So we've got a servicer type perspective, and then we also obviously have some of our member type companies who are actually out there in the field doing work. And so I guess I wanted to start off with volumes. I know it's always the first thing that everybody wants, and lots of times everybody puts it at the end of their presentation, but I wanted to talk a little bit about kind of what the volumes are, discuss, kind of what you guys see as current broad volumes, projected volumes, and then what are those drivers that you think are going to kind of cause more properties to kind of follow the path of default, then which would require pre-sale preservation and post-sale preservation. So, Glenn, you want to start us out with what your thoughts are?
Sure. Thank you. Listen, volumes have been low. They've been low for the last 2 years. Our REO department's been flat. We've been averaging probably 900 properties every month. We bring in about 100. We sell off about 100, and we haven't really seen much increase. From a servicer's perspective, we feel like our increases are going to come from just market share. We see a lot of consolidation in servicing, and we feel like clients are consolidating their books as well. The borrowers today that are in default, they still have equity. Most of the borrowers are able to either reinstate or sell their house and pay off the mortgage and still walk away with money in their pocket. So, we like seeing that kind of activity. Obviously, we want to keep borrowers in their homes. We don't want to eat up equity with foreclosure costs, expenses, et cetera. So we think that's a good thing. our opinion is that's probably going to change over the next 12 months, but it's not going to change next quarter.
Okay. Brian, what are you guys seeing out there?
I mean, from from our side, right? We touch multiple servicers, multiple REO agencies. So, we've seen a slight uptick in volume, but for the most part, it's flat. Our gain is much like Glenn said, in increasing market share or increasing, service area or client count. So we're not necessarily seeing huge surges. What we see on the REO side is we're seeing a lot more forceful evictions in place of vacant properties. But to Glenn's point, I mean, and you look at a lot of the economists out there, you see the stats. They're looking up from a volume perspective, but it's not going to happen overnight. It's probably over the next 12 to 18 months, in our opinion.
Right. Yeah, definitely, without a doubt. We've seen, when we talk about 20 and 30% or even 40% gains, it's on record low numbers, right? So it's 20% of, on 100 is, 20 more properties. So we're not talking, like you said, huge numbers. Dina, anything that you would care to add to that?
Kind of, Adam just came out with a new Q3 evaluation, and they showed that there was a 34% increase in the last quarter from Q2 to Q3 in foreclosure filings. So that will take a while, like Brian said, maybe up to 18 months or so before Glenn sees that REO volume tick up. But that is interesting. Purchasers, and I was looking at the housing market indicator report from August to September. New home sales declined by 8.7%. Foreclosure starts for the month were 22.9, up from 21,000 in August. But we're still sitting at FHA with 10.4% of the seriously delinquent, and prime, like the GSE portfolio, at only 1.4. So I think what we're seeing in our portfolio from the preservation side is they've got 54% of the market, and that's what we're seeing on our side too. So,
Sure.
But they only have about a 10% market share, so it is interesting.
Yeah, no, like I said, obviously, as we start to kind of delve into some of the disposition strategies and some of the other things, we'll touch base on maybe some of the differences between, your GSEs and then more your traditional HUD, which definitely pose a lot of challenges, especially on everyone's side, servicers as well as the field service providers. So talking about, with the volumes now, what are you guys seeing as some primary disposition strategies in terms of, preventing properties from going into, kind of the buckets? Because again, over the past several years, right, there's been huge investor interest in the space. There have been lots of, Adam is very keen on telling us about how even small investors, not institutional investors, are kind of coming into the space. You've seen this onslaught of non-performing loan or non-performing note sales, lots of early disposition strategies along those lines. Are you guys, what are you guys seeing? Glenn, let's start with you again, if that's all right.
Yeah, no, that's a great question. And, pre-moratorium, pre-pandemic, we were repairing probably 60% of our REO portfolio. And I mean, I'm talking like major renovations, $90,000, $100,000 rehabs, doing full renovations on our REO. Our clients were looking to sell to end users. We could qualify for all different types of financing. So we were getting a really good return on investment by doing that work. And look, it was good for us, good for the communities, good for everyone, right? During the pandemic, our distressed properties became very scarce, and there was a lot of investors with a lot of funding to buy as many distressed properties as they possibly could, whether it was to flip it or to turn it into rental. So we saw a shift in the market where our as-is REO were getting multiple offers well above list, and our repair properties weren't getting a lot of activity any longer. So the strategy shifted to, let's put it out there as is. You know, we'll test the market really high, maybe 20% higher than the BPO while we get the bids for repair. And, you know, within a week, we would stop the bid process on the repairs because we have multiple offers. That went on all the way up until probably April of this year. We all know what happened with the interest rates. I think a lot of investors got stuck, you know, holding the bag, so to speak. Like, you know, the money's not cheap any longer. There's no longer that desire to absorb as many distressed properties as before. And our clients are all going back to that original strategy that we ran from 2010 through 2020, where we're now repairing a pretty good size of our REO book again.
Okay. All right. Brian, Dina, anybody have any thoughts? Again, like I said, prior to kind of getting all the way through that process, what are you guys seeing as far as that goes?
Yeah, I mean, I think it's two-part what I'm seeing. I mean, obviously in recent conversations, you know, at some of the industry events where I'm talking to REO shops as well as some brokers, you know, we're seeing more of a shift into that repair strategy from as is. You know, with the interest rate increases, I mean, you know, a lot of your institutional guys are paused from a buying or acquisition perspective, and they're evaluating their markets. But you know, we're starting to see more of, hey, we understand that this is going to the end user or owner occupant. So, you know, that need for kind of the heavy repair strategy, not just the financeable. And then, you know, we're seeing a lot from specifically the Fannie Mae side. I mean, you know, with their regulators, you know, they've got a strategy where they need to repair, you know, most of their assets, approximately 70% of what's in their inventory, to kind of a max repair strategy. So they're really combing through these properties and making them, you know, a really nice end user, a really nice property for that owner occupant that's going to be buying. So that's what we're seeing, you know, from my perspective. I'm sure, you know, Dina's got some opinion on that as well, what she's seeing in the space.
Yeah, I still think the CWCOT, the conveyance without conveyance of title program and second chance, especially on the FHA side, is going to continue. But I think as the markets soften, those investors aren't acquiring at auction or second chance as quickly as they were. We're starting to see more go down the traditional FHA conveyance pipeline as opposed to the sales. It's starting to slow a bit, but still the majority of them are going the CWCOT or second chance on our side. As far to Brian's point on the GSEs, we are seeing them starting to, they really care about the communities that they serve and making sure that those properties look good, and they are spending the money to make sure that happens. So.
Okay. Yeah. So, I mean, again, one of the challenges that we see in terms of, you know, inflow into the pre-sale bucket are those disposition strategies. So as you indicated, Glenn, lots of homes that are in distress, people are turning around selling them, you know, before they kind of go through any of the process to get them into the buckets. We've also, you mentioned CWCOT. That's huge in terms of, you know, where it goes through before property preservation kind of even comes in. They have, you know, lots of challenges that are out there as well. So I guess, you know, what we wanted a little bit talk about was FHA conveyance. And I guess, Dina, we could probably start with you. You know, that's a real challenge from a disposition strategy that bypasses a lot of the brokers out there. Is that, you want to go ahead and start and talk a little bit about that challenge?
Yeah, so it's certainly the highest risk portfolio that we have. When you were talking, Eric, about before preservation kicks in, our most successful clients are the ones that dual path it. They work towards conveyance and getting the property in conveyance condition at the same time they're doing the CWCOT and second chance. So if the sales are not successful, then they've already got the majority of the work done and they're ready to convey in in that 30-day tight timeline. So that's the biggest success. The clients that are not dual pathing are really struggling with the conveyance, but that piece needs to be micromanaged from the inspection side, making sure that we're really looking at, is it really truly vacant and abandoned at each time we're inspecting it? Because if we miss that for 2 or 3 months, it could be considered mortgagee neglect, and then they're going to be looking at our pockets to restore the property to whatever condition HUD thinks that property was in at the time it should have been deemed vacant and abandoned. And then at first time vacancies, securing it within 5 days of the posting, making sure that you are following investor guidelines, and having it winterized, pressure tested, and that you're curing deficiencies and taking care of surchargeable damages. So.
Thank you. Brian, I mean, obviously the idea that, you know, if it's missed, you know, putting it into a marketable condition is a challenge. And it's, again, it's something that it's a cost of doing business. What do you see as some of the bigger challenges when trying to service FHA properties?
I mean, I think the biggest challenge that's kind of the 900-pound gorilla in the room is pricing. You know, on the pre-sale FHA side, they haven't addressed pricing in almost 20 years. You know, we've got inflation at record levels. I mean, labor, the cost of labor at record levels. And we're kind of asking people to do things for, call it 2008 to 2012 pricing. And what you've also seen with that is your portfolios, you know, used to be kind of 80% centered in a metro area with 20% in the rural. I think now you're seeing more of 80% in the rural and 20% within those metro MSAs. So, you know, location and pricing, obviously the further away from a major city you get, the more it's going to cost. The likelihood of having crews that live in those very rural zip codes, you know, albeit you have national coverage, those guys are coming from somewhere, you know, whether it be 30, 60, 80 miles away to service those properties. So as an industry, we really have to look at that cost, right? And I know NAMPS is doing that, and I know that you've had some success with the GSEs, but you know, hopefully we can get FHA on board with, you know, some pricing increases that'll be beneficial to the boots on the ground that are working on the properties.
Yeah, as you indicated, we've got that initiative going, and you know, some positive movement. Obviously, a bit late in kind of coming, but definitely kind of moving towards in the right direction. So obviously.
Absolutely.
Yeah, we've talked about, you know, kind of the volumes. We talked about disposition. Things then ultimately do kind of fall into the bucket, what we would call pre-sale in our world. And pre-sale properties are, you know, pre-foreclosure sale. The bank doesn't yet own it. Lots of times it's driven off. Well, it's inevitably. I shouldn't say all the time, but in most cases, the property has to be vacant in order for property preservation services to take place. There are some servicers who take an approach of anything on the exterior that they might want you to handle as well on the pre-sale side. But you guys want to, Brian or Dina, whoever would like to take it first, do you want to talk a little bit about the lack of standard approach or the various approaches that you get on a pre-sale property, and you know, kind of dealing with different entities, you know, how they look at handling pre-sale preservation?
Yeah, sure. You know, and I think it's so various in approaches to how you handle this space. I mean, you have some servicers that want to be the good neighbor and go to, you know, on a scale of 1 to 10, they're a 10 out of 10, right? They're going to address everything exterior. They're going to make sure there's zero blight in the community and that things are being, you know, kind of over-serviced, right? I mean, to the point where you can't tell that it's a vacant home or that it is going through a foreclosure. And then there's other servicers that take a more conservative approach to, you know, hey, we don't want to touch anything that we're not going to get reimbursed for. And I think that's where things get a little trickier, a little dicey, is depending on the client base that the servicer has, is going to depend on the overall aggressiveness of spend or of, you know, kind of protecting these assets and what's really considered protecting versus improving, so to speak. I think there's definitely some discrepancy there and some opportunity to kind of bridge the industry closer together, as we talk about these challenges that we all face, right?
Sure. Dina?
Yeah, and I think the disparity is more the non-agency loans, because the agency loans, which would be your Fannie, Freddie, USDA, VA, FHA, there's a common denominator there, and they all want their properties preserved and protected. There's not one of them that doesn't. And I think there's some confusion as to what that means. In pre-sale, we're not going to do cosmetics unless it's a code violation. We're not going to do improvements to the property unless it's a code violation. So you're going to minimize any kind of repairs, and you're focused at the holistic level of preserving and protecting the asset and ensuring that under your care and custody, it's not depreciating in value. So getting it secured quickly, identifying the surchargeable damage, and that would be something that a hazard claim could kick in for. It could be theft, vandalism, it could be hurricane damage, flood damage. You're going to want to identify that the first time you're at the property, because there's a statute of limitations in each state as to how long it takes you to file that claim. And if you've waited too long, then that agency could consider it mortgagee neglect and come back to the servicer, who then would come back to the preservation vendor pockets for any of those damages. So the biggest thing that I like to break down in pre-sale is, besides your regular maintenance, you're going to maintain the lawns every couple of weeks, grass cuts, snow removal, you're going to winterize per the investor guidelines, you're going to maintain to that investor guidelines. And each of them, I think they have their own secret sauce. There isn't consistency in it, but there is consistency. While there's not in pricing, there is consistency in what they want. And I break it down to the 4 S's. If it's a safe, sound, secure, and sanitary, other than regular maintenance, you don't need to do anything. If there's something that falls outside of the safety, soundness, security, and sanitation, then you need to take care of that. You need to get your clients' bids if you're a preservation provider, and making sure that you use that language to let them know why it's a safety issue. We need to take care of this because the electrical's exposed, or there's a hole in the yard that somebody can trip on, or the sidewalk is popped up and can create a trip hazard. So using the right verbiage to get your bids approved with the agencies will go a long ways. So other than the 4 S's, then you're going to look at, is there an HOA or code violation? And then you're going to work to try to cure those deficiencies.
Okay.
But you're not touching personal property. That's a huge differentiator on the pre-sale. And you also want to take really good care of it, because we've had properties where roofs are caving in, but there's personal property underneath. So you're wanting to make sure that you're not damaging that personal property as you're trying to preserve and protect that property.
Sure, and obviously another challenge that that our industry faces and servicers face is the length of time foreclosure takes, right? Because it's not a universal across states. I mean, if you're in New York, and I know lots of people are challenged by New York. I mean, the average is 5 years, so that's 5 years of minimal maintenance, right? And so that adds another challenge to our to when the property actually kind of moves through the process. So again, those are challenges for us. Go ahead.
I think it's important to address, what you just kind of brought up, Eric, and it's outside of that one size fits all approach, right? I mean, I remember on the kind of the pre-meeting for this call, Glenn and I had a discussion about, properties in New York where, servicers may tend to tarp a roof 4, 5, 6 times. Is it a better decision to do a repair, which would fall outside of the norm for what a pre-sale approach would be?
Sure, absolutely. Glenn, what do you have on this?
I was just gonna say, I agree. I mean, tarping a roof is temporary, right? It's a good 30-day. It's a good 30-day fix. If you're going to sale within the 30 days, then you pass it down to REO and let them figure out what they want to do. But if you're tarping the roof and you're early in the foreclosure process, I mean, how many times can you tarp it? How much damage are you causing every time that tarp blows off? You know, we're all about patching, getting that longevity of a really good patch or repair, not necessarily replacement, right? But
Sure.
you know, just getting it through that 3, 4, 5-year foreclosure process without any further damage coming from that hole in the roof that you continue to just tarp every other month. And listen, you talk about New York, long foreclosure timelines, also very, very difficult on, you know, you get a lot of violations, you get a lot of fines, you get a lot of penalties. I mean, just, you know, when you're pre-foreclosure, you have to be really, really smart with your preservation. You don't want to be the house where all the neighbors are complaining and calling code enforcement every week. And, you know, just spend the extra money. You're in for the long haul. It's a good investment and it keeps you out of trouble.
Sure, sure. Dina, you had something else to add?
Yeah, real quick on the roofs. We like to train to do, if it needs to have, say there's 4 leaks, if it's pre-sale, you're not going to get your investor typically to pay for a brand new roof. Very risky. But you're often not going to be able to patch it within the $600 allowable. So we're saying, okay, give us a bid to patch 5 leaks or 4 leaks. Maybe that's $1,900. I don't know what that is and what's involved and how many squares. It's on a case-by-case basis, but also give us a bid to replace. So when we go to the agency with an over allowable, we give them 2 options. The tarp's temporary. We have the tarp on there. It's only going to last 30 days max, right? But here's the 2 bids. The roof has reached the end of its economic life. It needs a new roof. And here's the patch. It's a temporary, but it's much better than the tarp. 9 times out of 10, they're going to approve that patch bid. But then before conveyance, you can remind them, hey, that roof is at the end of its economic life. Do you want us to replace it before we convey it? And that eliminates the risk from the servicing level, preservation level, all the way down.
Sure.
So.
Yeah, and a lot of that obviously is timing, right? Because one of the big concerns on the pre-sale side is the bank doesn't own it, right? So there's a lot of concern around disparate impact, right? And so, you know, if you're spending someone's money, you know, and you approve it, then if the homeowner wants to come back in, they're ultimately liable for those kinds of costs in order kind of, you know, to become current again. So I know that's a little bit of a challenge. And then obviously there's also concerns from the CFPB that you're treating X property differently than Y property in different socioeconomic or just geographic locations as well. So do you have a little bit on that, Dina, that you wanted to speak to at all?
Well, I know with the GSE clients, they're just great at really, one, across the board, I think as a preservation professional, you have to make sure you're treating all communities the same nationwide. So having good, solid procedures and practices that don't vary from community to community is essential. But then I think there's some of our clients, and including our GSE clients, have taken it a step further, saying they want to be the best house on the block. They don't want to look like the old REO property. They actually want to pop. They want to have manicured yards. And I'll let Brian talk a little bit about that, but they really definitely want to spend their money in making sure that they're good neighbors in every single community consistently.
Yeah, and sure, on post-sale, we definitely jump into that. Brian, you brought up on the pre-sale a lot of questions around code enforcement and things along those lines. Can you give us a little bit more on the code enforcement piece of it?
Yeah, I mean, look, I think it's important to talk, you know, your local code enforcement officer, and they can either, you know, as you're working as whether you're a preservation vendor, whether you're a broker, whether you're an agent for a broker, whether you're a servicer, the relationships with these guys can make or break what happens on a property. In areas where you have good relationships and you're proactive, and you know, look, from a prop pres side, a lot of times, you know, we don't have the overall authority to fix it right now, but we want to have world-class communication with them. We want to talk to them on a regular basis. When there's a notice, you know, posted, we want to proactively reach out. Hey, what's going on? What's on your mind? What are you feeling towards this asset? I mean, this is what we feel needs to be done. This is what we think realistically we can help facilitate. But owning those relationships with the local code officers is imperative to success.
Yeah, without a doubt, it's definitely changed. I mean, from before, it was a little bit adversarial, I think, until probably in the past 10 to 15 years, right, when the last housing crisis occurred, it forced everybody to kind of change that. Glenn, what's your approach when obviously from a you get one of those large repair bids that kind of comes as a result of code enforcement? Is there something that you guys, does that go through a different path, or is that looked at differently, or how exactly do you guys handle that?
No, obviously, we want to deal with code violations head on. We want to have that communication with the inspector, the code enforcement officer, like Brian said. We utilize our vendors, ZVN, to get their network out there, do meet and greets, just make sure we're covering everything, and then again, you have to maintain it from that point on. So, you can get a code violation that's a pretty hefty ticket. You get all those repairs done, and again, you're still facing, a 2 or 3 year foreclosure timeline. You have to make sure that you're maintaining it from that point on. You can't just do a one-time fix and expect that code enforcement officer not to bother with your house any longer. They're going to continue inspecting it. You have to continue maintaining it. Insurance claims can help in some cases, but other than that, you really just need to be very hands-on when it comes to code violations, code enforcement, and everyone knows those violations carry into REO. You're going to deal with them sooner or later. Get it on the pre-sale side. And so whether you're conveying it or you're moving it over to your REO inventory, you cleared all those violations, you negotiated down all the penalties and fines. If you let that stuff go on for months and years, your REO asset management company or asset manager, they're not going to have great results trying to negotiate with that code enforcement officer that late in this that late stage, right? You got to get ahead of it. You got to get ahead of it in pre-sale. And you got to clear all those. If you fix all those violations, your fine becomes practically nothing. If you let it go on for years and years and years, that property becomes very well known. It goes into REO. It's impossible to negotiate those penalties and fines down.
Yeah, or in worst cases, and the absolute worst cases, you come back and somehow it's condemned, and now you're vacant lotting it, right? Now you're selling the piece of land only, not the asset, for sure.
Yeah, either you get a tear down notice or they put a receiver in place, and that's a nightmare situation. You'll spend 3 times the amount of money once a receiver's in place than you would have if you had just addressed it at the time the issue occurred.
Sure. And so the last thing on pre-sale that I just wanted to touch base with is that there's kind of some unique strategies that are out there in terms of actually some GSEs taking on the responsibility on behalf of the servicer, right? So, and with that type of solution, you're seeing some different, non-traditional, I guess I'll say. Typically you mentioned, Dina, we cut the grass, every other week, kind of 2 times a month. And this new strategy that's out there, specifically with Fannie, they're kind of out there every single week, right? Cutting the grass. They're doing a lot more of these repairs and things along those lines because they're trying to protect their asset. Is that something you believe, could be like kind of a standardization for us to kind of look at in terms of approaching all properties going forward, or?
Yeah, good question, Eric, because most of the investors, and I know HUD, for instance, if it is a local jurisdiction that they require weekly grass cuts or weekly inspections or biweekly inspections, as long as you put your over allowable in, it's approved. So I think understanding your local markets and what the code officers expect in those markets. I know when you're getting a lot of rain in some of these areas, especially in the northern states, the grass is going to get, I mean, in my area, sometimes we need to mow twice a week. So it just every 2 weeks, you're still going to get 7-8 inches of grass in between that. So I think understanding that, but from a consistency standpoint in the growing season, a lot of these markets need to have weekly grass cuts.
Absolutely, absolutely. So now we get through everything. We've dispositioned before. We've been able to move it. We've gone through the pre-sale process. The foreclosure sale takes place, and now we have what is called the post-sale property in our world, in the mortgage field service industry. What are kind of some what does that look like compared to pre-sale? Brian, why don't we start out with you?
Yeah, I mean, yeah, and I think, you know, obviously post sale, you know, we're getting it cleaned up, ready to go, and in most cases, you know, it's going to involve some sort of renovation project, right, or a rehab. You know, depending on whether it's an agency property, whether it's conventional, you know, often is going to depend on the renovation approach. But I think in most cases, you know, we're looking at, you know, co-scoping with brokers. You know, they have the local sense to the market, what it's going to take to get that thing sellable. Having realistic conversations, right, on what delivery looks like of that process. You know, most clients, servicers, GSEs, you know, they're not wanting to relocate windows, doors, walls. I mean, they want to restore it to add value, but they're not looking at, you know, a lot of that type of renovation. I mean, it's still a high dollar renovation, but it's, you know, let's put this thing back to original. Let's make sure everything works. You know, obviously a modern touch, but I think it's important to realize, you know, not everybody that's in default servicing from a preservation standpoint is a renovation contractor. And, you know, it's going to take a specific company to partner with to work on those type of assets to get the outcomes that everyone desires. Just because everybody says they can pick up a hammer and renovate a property doesn't necessarily mean they can do so, and definitely doesn't mean they can do so to scale. So I think understanding that approach and setting out expectations from the beginning, you know, the broker needs to set their expectations to the contractor, and the contractor needs to likewise set those expectations to the broker as is, this is what you're going to get. This is what the timeline looks like. You know, overall, we both have the same client we're trying to fulfill here. This is what their repair strategy looks like. You know, how do we play within the kind of guardrails, right? And get this thing completed, get it completed in a timely manner, get it back on the market and get it disposed of is what the goal is.
Sure. So Glenn, you know, Brian talked a little bit about co-scoping and the importance of working with the brokers. You know, in the past, you know, there's kind of been unfortunately a one size fits all, or, hey, here's 3 different colors of beige carpet that you can choose from: light beige, you know, medium beige, or dark beige. How do you guys look at, you know, the disposition strategy on a post sale? What do you guys find?
Yeah, we look at it, you know, we work very closely with our brokers. You know, we're pulling all the comps. We want to see what's listed on the market today, what's sold in the last 90, you know, 120 days. Really identify, you know, how can we get our property in the condition to compete very well with what's listed today, right? So, you know, we're looking at the interior pictures of sold comps, listed comps, having our brokers do a lot of research into, you know, who the buyer is in the marketplace, et cetera. And we're really using those interior pictures to do the right rehab, to get the right scope with the agent, make sure everybody's bidding that scope apples to apples. We've always felt like, you know, we have to be just as nice or better than the comps, and we have to be priced right to get the property moved. So, you know, the brokers play a big part of that, right? When you're looking at the comps, you're telling the broker, yeah, we need to do this. You know, we need these quartz countertops. We need these higher end cabinets. This kind of flooring we should go with. And you're really just taking all that data from what you just saw in the marketplace and creating that scope of work. The biggest mistake in REO is you start cutting out line items. Hey, don't do this, just do carpet, don't do hardwood floors, and then you expect to sell it for what the comp sold for, but you're not the same product any longer. So you have to be conscious of that. If you want to list at the top of the market and sell at the top of the market, your house has to have the rehab that has that same quality that was at the top of that market.
Excellent. Dina, you in a former life, I think you did some broker work as well.
Yes.
Any thoughts?
Yes, I am still a licensed real estate broker. I believe that the agents drive a lot of those decisions. Like Glenn said, they're just a strategic partner. And on our side, on the preservation world, which is where my 100% of my focus is on right now, on the REO side, is having our vendors meet with the brokers, walking the property with the listing agent, and making recommendations, because the listing agent's going to know their market better than anybody else. If it needs paint, they're going to know what color is popular in their market even. So not assuming, but really pointing out maintenance things. Does the house need to be pressure washed to pop? Gutters cleaned, roof swept off? What can we do to help support them and help get the maximum returns on that asset? So just really leveraging relationships. It's all about relationships.
Sure. Excellent. Okay. Well, along those lines, there are obviously, some disposition strategies that are out there that some brokers can bring forth, relo assistance, 203K, lender-based repairs, right? Lenders may have their thoughts on, these are my standard book of repairs and things along those lines. I mean, what challenges do those bring into the disposition strategy in terms of that? Dina, do you have any thoughts on that?
Well, I know cash buyers is what the asset managers want, right? But there are certain companies out there now that actually have products that can help people pay cash for a house when they really don't have cash, if they're trying to sell their other house. So it can actually kind of give them essentially like a bridge loan to be that cash buyer when they find the right property. There are other alternatives that I think are coming up that may not make you as attractive if there's multiple offers, but the FHA 203K program, I think, is getting dusted off again and starting to be used for that owner-occupant borrower. Now with the agencies' REOs, they are all striving to get owner-occupant purchasers. So the first 30 to 60 days is owner-occupant offers only. And I believe with a 203K, they can actually use that, especially the streamlined, use that $35,000 to put the property into minimum property standards for financing, and then use the additional monies to do some renovations or something like that. So it is something that is starting to get reconsidered again. And there's other products besides FHA that are similar to that. So
sure. Okay. All right. Anything else, in terms of, I know we talked a little bit during the pre-conference call here about turns. Do we want to touch base a little bit on what we're seeing in terms of rentals and turns that are ultimately kind of maybe possibly showing up on the market? Are we, Brian, is that something that you guys are seeing? I mean, I know you do turns. You want to talk a little bit about that, provide some color on that?
Yeah, I mean, I think what you're seeing, right, is you had all these institutional guys go out and gobble up every, ugly REO asset out there, and they had a big budget to put these things back into marketable, rentable condition. They've done so fairly successfully as cost of capital was inexpensive, but now as everybody's looking at their P&Ls and their balance sheets, the cost of money is expensive, and they're starting to look at what markets perform and what markets don't. And I think you're starting to see some of these guys disposition on a turn to where they'll put it back in, and instead of putting another tenant in place, they'll look to to disposition that property. I think you've got other investors that are looking to disposition entire markets. As the market in general maybe didn't cap rate out is what they thought it did on paper. So I think you're going to see, you could potentially see an increase in, call it REO disposition volume from that standpoint. Yeah, I mean, I think it's here, and we're seeing some of it already. Does it get? Do you see an increase of that? I mean, look, I guess if we all had the crystal ball, we could have predicted the 2008 crisis and the influx of REO in 2012, and we'd know what's coming in 2024 through 2026. But only time will tell to the extent we see that.
Sure. On those, are you actually that's just kind of the institutional investor, or are they doing something similar where they're kind of finding a listing agent, broker, and then you kind of co-scoping, or are they kind of, they've already kind of done all the repairs that they really have an appetite for? What do you
see? On that side of things, they don't typically get in there. What we're seeing anyway, right, is we're not getting into the co-scoping on those properties. It's, hey, put it back to kind of like condition that it was once received in, or we know we did the initial repair, so we're going to replace 2 rooms of LVP, we're going to paint 2 rooms and maybe put a new stove in, right? And those are the types of repairs we're seeing on a turn to disposition, right?
Okay, all right.
So on that too, Eric, I think a lot of the agents, as the markets start to soften, are going to see a return to protecting tenants at Foreclosure Act and having to deal with actually bona fide residents in place. And so the agents being able to pivot and sell REO with tenants in place is going to become a thing again, because the law sunsetted in 2014 and President Trump enacted it as permanent legislation. And so a lot of states have even more stricter requirements around the PTFA. So I think agents will have to get used to that more. I think they're starting to see a little bit more of that at auction.
Okay.
So, the other thing is, when you've got a fourplex, recommending that you vacate a performing building to sell it all vacant is actually taking financing opportunities away from an investor who wants to buy a 4-unit income producing property. So it's something from an agent perspective to be able to at least coach or counsel your asset manager if they're saying, hey, evict all 4 of these residents, that perhaps that may not be the best strategy to maximize returns. So
somehow that makes it less attractive to sell, right?
Yes.
Kind of
Correct.
like that. And we have a kind of a pathway forward, right? Because that's what happens whenever buildings are sold, right? Commercial structures are sold. So there is a pathway forward for that. There's kind of like a little path. Glenn, what are you guys seeing? I mean, you talked a lot about like full-on rehabs and things along those lines, and that's kind of you're seeing that kind of a return to that. What is that? Do you think that's for the longer term? Is there a concern as it relates to that? Then thus with the interest rates being where they are, is it kind of like a balancing act? Is that very difficult? Do I do a full repair and then it's 7.5, or do I sell kind of as is, or with minimal repairs because interest rates are 7.5%, 8%?
Yeah, so I think it's going to be the norm going forward. The major rehabs, for a consumer paying a 7.5% rate versus an investor where the rates are closer to like 9.5. There's a lot more carry for an investor right now, and on the rental side, it's hard to pay the 9.5% rate and get that debt service coverage. And so I think the end users are the focus today, and I think it's going to be the focus for the next 12, 18 months. So I think the repair strategy is only going to increase throughout REO servicers versus decrease and go back to selling as is again. There's just the money for investors 2 years ago. The money was inexpensive. There was plenty of it. Hundreds of lenders and funds got into lending that type of product. And, these investors, instead of buying 2, 3 projects at a time, they were buying 10, 12, 20 projects at a time. And I think they're going to have a hard time getting out of those. And I think they're going to be very conservative going forward, where they're back to just doing 2 or 3 at a time again. And so I think it's up to us as the REO asset manager to identify who that buyer is going to be, and what we should do to that house, along with our agent, to get that end user in there. Look, you have the Fannie Mae, and others have that first look timeline, where the first 25, 30 days, only end users can put in offers. But in order for those programs to work, you have to have a financeable product out there to do it. And I think it's important that everybody recognizes that.
Yeah. Okay. All right. Well, I think it's been a good conversation. Wanted to kind of close with, before we get into the questions, what I guess is one best practice that you'd like to see adopted as an industry standard as it relates to post-sale properties? We'll stay away from pre-sale, because obviously brokers and people from you really can't necessarily touch those. But what would you guys like to see happen post-sale? Brian, I had you down to start. Is that fair?
Yeah, I mean, it's fair, but picking just one, Eric. I mean, there's a lot out there, right? So, I guess if I had to narrow it down to just one, on, call it the post-sale side, is as much as we can look at best practices to create, a single workflow, right? Are we going to maintain all of these properties to kind of the highest standard? Are we going to, if we could make it cookie cutter to that point where it's like, hey, we are going to maintain, or groom all of these properties to eliminate blight from all communities, I think that would be, the best practice I could say for kind of the, the people of these communities, right? If every REO property that's in these communities all looks the same, and it's equal to what the average home in that community looks like, I don't think you have any your property isn't bringing down the value of neighboring properties. It's only helping neighboring properties. You have less blight, less crime on these properties. So if I could take one thing away, and it's a big one, right? It would be some sort of universally accepted standard as to the condition we put these properties in.
Okay. All right. Glenn?
Yeah, I agree with Brian. Just be consistent on the way you maintain your properties. Your post sale, you own it, you're responsible for it. Don't just cut the grass, right? You have to edge, you have to mulch gardens, you have to trim bushes, you have to clean gutters, you have to blow leaves off of roofs. You got to fix your storm door. You have to do everything that, a homeowner would do, right? It's an owned property. Imagine if you want, 2 years without trimming your hedges, your house is going to look like, it's abandoned. And all these REOs do look abandoned, and you have to try to make them so they don't look abandoned. So just maintain the entire house as if you own it, because you do at that point. As a company, you own that property. So, cutting the grass is great. And I know that's the beginning of preservation in REO, but, mulch gardens, trim hedges, again, clean out gutters, make sure you're doing seasonal work so you're not the blight in the neighborhood and you don't look like an REO. I think that's important. Curb appeal.
Sure. Absolutely. Dina?
Yeah, I absolutely agree with what Brian and Glenn said. I think none of us want to live next to a blighted property. So consistency in making sure that property is maintained to standards is huge. But I'd also like to take this opportunity for best practices, both pre and post sale. Whoever is pricing needs to reevaluate pricing for our industry on an annual basis and give us the same consideration the attorneys get on the foreclosure side, which is reevaluated every year. We've gone 20 years without adjustments, still expecting to do $20 inspections in rural areas, taking 2 hours to get to round trip. And this industry, I've been in it over 3 decades, and I'm passionate about our industry. But to see great preservation companies going out of business because they can't make enough money is sad. So if we could have that consideration just on an annual basis, it doesn't mean adjustments are needed, but to not ignore this industry, that would be the best practice that I would want to take away from that.
Couldn't agree more. It's obviously you as being on the NAFS board are aware of the things that we're trying to do there and get some kind of, hey, commitment, COLA, adjustments, dialogues. Those are big things. Yeah. So I think, like I said, I think we've moved a long way from where we were. But we do have, unfortunately, a long way yet to go. So yes. I would like to thank everybody today for their time and sharing their expertise. Right now, I'm only seeing one question in the box, and it is a question that seems like it's more kind of NAFS directed, is who can I speak to learn more about the field inspection process? And so I guess I will go ahead and throw out my name, Eric Miller. You can reach me at eric.miller@nafs.org. So that's Nancy, Alan, Michael, Frank, Sally.org. Another comment that's just come up is well done, panelists. So Justin, thank you very much for the kind words, and we were glad that we were we were able to share our knowledge with you. So I'm not seeing anything else. Am I missing something in the chat or anything like that? Stephanie? No? With that, I'll turn it back over to Stephanie. So thank you very much, everyone.
Okay.
And I want to thank all of you. Thank you, Eric, Dina, Glenn, Brian, and everybody for joining us today. This webinar was taped and it will be emailed out to all of our attendees. And then you can also find those replays on the NADP website, defaultpro.org, underneath the education tab, and you will find all of our webinars for replay. So thank you again for great information, guys, and sharing your time with us today.
Thanks, Stephanie.
Thanks, Stephanie.
Thank you.
Thanks, everyone.
Thanks, everyone.